The majority of the stock market is down today, giving us a great opportunity to find undervalued dividend stocks. And in today's episode, we are focusing on 4 that are below $50. We're going to look at each one, as always, a quick historical performance outlook. Then we're going to take a look at their dividend safety, look at some of their supporting metrics, like their free cash flows, their debt levels, and then we're going to run each one through the valuation model, getting to both the intrinsic value as well as our acceptable buy price. We're going to implement our margin of safety and then take a look at Wall Street and see what they are forecasting over the next 12 months. So the first one that we are taking a look at today is Kroger, and we do get a buy rating from Wall Street, however a double hold from the other two analysts. It is trading right now towards the midpoint of the 52-week range. It does have a forward yield around 2.31% and a forward P that is trading fairly low at 11.34, but as always we will compare it to the sector average. Over the last year, it is up nearly 8%, and if you've been a long-term shareholder, you would be up around 100%. Bear in mind, if you do reinvest those dividends, you would be up slightly higher, and we can see all-time highs sitting around the $62 mark around 2 years ago today. So let's take a look at Kroger. Now, the dividend safety score does sit at 71, so it does look to be safe. Market cap, $36 billion. We're talking about a large cap company, and it was reaffirmed at the end of March that dividend safety score indicates a dividend cut is unlikely. Now, in terms of the last recession, in fact the Great Recession of 07-09, they did increase their dividend, which is good news if you see a dividend, or in fact, which is good news if you see a recession inbound. In terms of sales during that period, pretty much flat, which was above the average of the S&P, coming in at -12, and they also significantly outperformed the S&P, -31, with the S&P itself -55. One of the things I love about Kroger is it is a very strong dividend growth company. Double-digit increase last June, double-digit increase over the last 5 years, as well as over the last 10. And we can see this is a company that's been increasing those dividends over the last 17 years consecutively. Now, on this channel, we do spend quite some time analyzing dividend yield theory, and it does state, especially for the newer viewers, that a company is undervalued when the current yield sits above the 5-year average. So we have a sign of undervaluation on the yield, as well as on the forward P, 11.2 sitting below the 5-year average of 12.1, and in fact also below the consumer staples sector of 17.7. So we have a triple undervaluation signal on today's episode. Just bear in mind, we don't look at any of these models in isolation. We will conclude towards the end. In terms of the free cash flow payout, remember we do focus on this as the earnings is susceptible to manipulation by management through accounting. Below 60% is our preference, pretty much giving us faith that management can offer those double-digit increases that we love to see. And for Kroger, it's been below that for the majority of the last 10 years, 28% in 2024, 32% expected in 2025, so we would be surprised if we don't see another nice strong double-digit increase to their dividend this month. In terms of the free cash flow, well, very important, we do want to focus on companies that increase it consistently over the longer term. Now, you can argue with KR that it doesn't have that consistency, but we do note from 2015 it has increased very strongly into 2024. We would just point out that it is anticipated into 2025 a drop to the free cash flow. Now, in terms of the sales growth, again, what we do look for is a borderline growth rate of 3 to 7% at a minimum. Over the longer term, they do hit that in the majority of the years. However, the more recent year at 1% is a little bit of a worry, something just to think about. With prices increasing due to inflation, consumers may be looking at other places. So again, we do see that 1% target, although historically it hasn't been too bad. And we can see numerically over the longer term, they have increased their top line by around 40%, 108 billion to 150 in the more recent period. On top of that, not just increasing those dividends double digits, but also doing a lot of share buybacks over the period, effectively returning excess cash to your pocket as a shareholder, as you then own a larger portion of the company. And in terms of the ROIC, very important, in fact, one of my favorite metrics to look at. 10% or more is what I target, giving me faith management are able to effectively allocate their capital consistently pretty much above that 10% level. From the lows of 2020 during that justifiable COVID year, they have been increasing it consistently. 15% in 2024, making it very attractive for investors as well as potential shareholders. Now, operating margin is one area that we would like to see them improve, although one thing we would say is they have consistently been around the 2 to 3% level and have been operating strongly as a company, but as we can see, it is a lot lower than the minimums we would typically look at for other companies. And on the free cash flow margin, a very similar story to be told here. 5% or more, but we can see just over the last 10 years it has been around the 1 to 3% level. In terms of net debt to EBITDA on the left, now very important as this does correlate to balance sheet strength, dividend safety. Net debt to EBITDA referring to the earnings before interest, tax, depreciation, amortization, and these effectively show us the number of years it would take the company to pay off all of that debt net of cash on hand. Below 3, and actually quite positive to note, from the highs of 2019 at 3.72, it has been coming down. 2025 expected to be pretty much in line with 24 at around 2.01. So we would indicate this is a very strong dividend growth company. Their total debt levels are fairly low, as we can see here. And in terms of that free cash flow payout, it does look healthy for those continued double-digit increases. Now, as always, let's jump into the valuation model. If you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, typically on the channel, we run through every single one of these models in our deep dives. Today's episode, we're going straight into that intrinsic value, which in today's episode for Kroger is just over $61. Now, margin of safety, how this works, we start off with 10%. We execute on that if it meets our 3 golden criteria: a wide moat, strong financial metrics, good forward-looking data. If you believe that for Kroger, ticker symbol KR, then it is a buy around $55. Then we keep going till it's near the current trading price, and what we can see in today's episode, it isn't too far off, in fact, a 20% MOS level. That is based on our estimates and judgments. And in terms of Wall Street, well, they pretty much see 21% implied upside over the next year with a price target of $60, not too far off our intrinsic value. So to summarize, for Kroger, a 20% MOS level with 21% upside, and do let us know your thoughts as we do go along these stocks today. The next stock that we are taking a look at is EPD, Enterprise Product Partners. We can already see a triple buy rating with a strong buy from Quant, and what we want to highlight here is that yield of 7.25%, looking very, very appealing. Forward P 10.41, it is trading in the midpoint of the 52-week range, and what we can see is over the last 12 months, up 9%. Over the last 10 years, however, we do want to point out it is down around 25%. Now, what it is nice to note with this company, with the yield of around 7.31, so the dividend safety score is sitting at 65, so it does look to be safe. It is also a large cap with a 62 billion market cap, and what we can also see, it was reaffirmed just last month that the dividend cut does look to be unlikely for this company. Now, in terms of the key recessionary metrics, well, they did increase the dividend during the last recession, below average growth, but they did also, in fact, outperform the S&P. Now, dividend growth for a company that pays a high yield, ideally we would like to see a minimum of 3 to 4% year on year, just to keep up in line with inflation. Last full year, 5%, so that is nice to know. Over the last 5 years on average, around 3%. Over the last 20 at 5%, indicating that if you are a longer term shareholder, it would be increasing at a minimum in line with inflation. And they are officially a dividend aristocrat. They have been paying dividends consecutive increases for 25 years. Now, in terms of dividend yield theory, we do get a sense here of reasonable valuation. It isn't too far off the 5-year rolling, and the same can be said for the P to DCF as well, 7.7 versus 7.6. Although when we do compare it, the energy sector is only marginally higher, so 3 signals giving us reasonable valuation. Now, typically with companies, we do look at the free cash flow payout as we did previously for Kroger. This is an NLP, so we'll be looking below 90%. In fact, it has been below that every single year, in fact decreasing 58% in 2023, 56% expected next year, so no worries with that dividend safety so far. Then when we draw your attention to the DCF per share, again, similar to most metrics, we want to see increasing over the longer term. That is what we do clearly see, and 2024 anticipated to be an increase from the previous year's results. So looking positive so far. When we look at essentially the sales growth on the right, we can in fact see, due to the cyclicality of this industry, that in fact out of the last 10 years, 5 of them have been negative, but it is very important. 2023, negative 15%, trading 12-month basis showing negative 10%. And what we always say with cyclical companies, you want to buy them when they're out of favor, when they're out of cycle, and then ride them to when they are very popular and in cycle. Now, shares outstanding, No surprise here with MLPs, they do need to issue shares. As we can see, they don't retain a lot of that cash flow as they do have fairly high payout ratios, and it hasn't been diluting your position that much over the longer term. In fact, over the more recent period, they have bought back some shares. And total sales, we do note the cyclicality. We can clearly see that from this image. In terms of the ROIC then, 10% or more, and it has been increasing over the longer term, just over the last 6 years in the 10 to 11%, as well as that trailing 12 month. Again, positive sign there for investors. In terms of the margin, well, operating margin, we can see around 16%. It does straddle around that, although it is a little bit inconsistent year on year. And with free cash flow, it isn't something, as we just discussed earlier, that is relevant for MLPs. So typically with other companies, whilst we look at it, we won't look at it today. Net debt to EBITDA below 4.5 for MLPs, and it has been decreasing, a very positive trend. 3.04 in 2023, 2.91 expected in 2024. So again, a lot of the right signals that you want to see. And as an added bonus, this does company pays a very nice starting yield. So let's jump into the valuation. As always, you can grab a copy of this model by clicking on the pinned comment below, getting to both intrinsic value and acceptable buy price of companies in your own portfolio. So margin of safety then, let's start off with 10%. What we see here then, a buy up to $29.41. 15% pretty much bang on the current trading price, around 22 cents shy. So this is one that if you do consider sufficient margin and you are attracted to that nice high yield, it could be one to consider after your own due diligence. In terms of Wall Street, well, they see the price not too far off our intrinsic value, 21% upside. So in conclusion, for EPD, 15% margin of safety, 21 upside per Wall Street over the next 12 months. Now, before we move to the next stock, just to let you know, we've released our latest free weekly article. If you want to gain access to this or any other articles, all completely free, click on that pinned comment below. You can start reading straight away. For example, if you want to find out the websites and resources we use, this is a great article to start. Or if you want to look at a more recent article on 12 undervalued high quality companies, again, another article to read. So the next company we're looking at is Suncor Energy in the oil and gas industry, a double strong buy rating and a buy from Wall Street. This is currently trading in the mid to lower end of the 52-week range, a yield trading 12 months of 4.17% and a forward P of around 9.19. Now, over the last 12 months, up 25%, and if you have been a shareholder over the last 10 years, well, as you can see, similar to others in the industry, you would be down around 14%. Now, in terms of the dividend safety score, 50 borderline safe, so we can have a look at this. Market cap just under 50 billion, so it is still a large cap company, and it was reaffirmed just a few weeks ago that the borderline safe indicates a moderate risk of a dividend cut over a full economic cycle. Now, last recession, they in fact increased the dividend. They had around average growth at the negative 14% and a near S&P return with that negative 51%. Dividend growth, well, above inflation just in November 23, 8%, nice high single digit over the last 5 years. Over the last 20, 17% looking very positive, but we do want to point out just 2 years of consecutive increases as we can see that dividend cut during COVID. In terms of looking at dividend yield theory, well, again, another reasonable valuation signal on both the yield here as well as the essential forward P, 9 versus 8.5, although we do know the energy sector as a whole is much higher at 12. Now, when we take a look at the free cash flow payout, 40% for oil producers, so it is lower than the others in other industries. What we can see just over the last 3 years, it has been below that. Expected 2024 as well to be below that at 41%. So a good signal there that we should see hopefully a nice, at a minimum, high single digit increase to the dividend this November. And when we look at the free cash flow payout, increasing over the longer term, but again with the industry, no surprises, cyclicality as we can see here. But what is nice to note is that expected 2024, the increase to the free cash flow from the previous year. No surprises with the sales growth, the essential cyclicality again being shown. We can see around 5 of the last 10 years negative growth, and in the more recent year, negative 16%, as well as the trailing 12-month at negative 13%. So if you want to see it in terms of graphically, we can see the ups and downs over the last 10 years. What is always nice to note though with these companies, especially oil and gas, where maybe it's not as common, the share buybacks over the longer term. Yes, we see some share issuances from 2014 to 2017, but from then consistently very small share buybacks over the period, always a great sign. ROIC then we do see here above 8% for oil producers, which they have maintained over the last 3 years. But again, bear in mind cyclicality with this industry. Every few years we will see positive followed by negative, as we have clearly seen throughout the analysis for Suncor Energy. In terms of the operating margin, again above 12%, we see that over the last 3 years. Pretty much the same over the free cash flow margin period as well, 21 to 23. Very strong, but again, prior to that, we do see a lot of inconsistency, which is why we always add that extra layer of security by adding a margin of safety before executing on stock. Net debt to EBITDA then, what we can see below 1.54 oil producers, and that has been pretty much the case over the more recent period. What we do note though, 2024 is expected a small increase from 2023, but still significantly lower than 1.5. So no worries with that dividend safety. We do see it as borderline safe at the beginning, but what we can see is the net debt to EBITDA as well as the free cash flow payout does look to be healthy for the time being. Now in terms of the valuation, don't forget if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. A 10% margin of safety for SU would be a buy up to $47. At 20% around $41.70. At 30%, we can pretty much see around 51 cents shy. So this is an energy, oil and gas, in fact, with a 30% MOS level. And when we take a look at Wall Street, well, they see 30% upside. So definitely one to consider for the portfolio if you are looking for companies in that sector. We then move on to a REIT today. We have Vici Properties, a triple buy rating, one of them being a strong buy. It does currently sit in the mid to low point of the 52-week range, a forward yield near enough at that 6% level, and a P to FFO at just over 11. Over the last year, however, it is down around 12%, and if you have been a shareholder over the last 5 years, you would be up around 26%. In terms of dividend safety, well, another borderline safe, so let's dissect that information. Market cap 30 billion, a large cap company, and we can see again, similar to Suncor Energy, we do in fact have that borderline safe, reaffirmed moderate risk of a dividend cut over a full economic cycle. So let's take a look at the recessionary metrics. Well, again, just to point out, this was listed in 2017. Therefore, there is no essential recessionary data. And when we do move on to the dividend growth, something I do quite like about this REIT, 6.4% increase in September and a double-digit increase on average over the last 5 years. In terms of looking at dividend growth, well, they have been increasing the dividends over the last 5 years. And when we look at dividend yield theory, we can see a strong undervaluation signal on both the yield as well as that forward P to AFFO ratio. We do also note the real estate sector does sit higher at 14. Now, with essentially REIT real estate investment trusts, we do focus on the adjusted FFO, a lot more volatile in terms of the free cash flow. And what we want to signal here is below 75% for hotel REITs, pretty much straddling around that over the last few years, so positive as well as 2024's 73% target. When we look at the AFFO per share, has been increasing pretty consistently over the longer term. No surprises for 2024, expected another increase to the AFFO. And when we take a look at this percentage-wise, we can see pretty much over the last 4 years, 3 of them have been double-digit increases, 11%. Trading 12 months as well, showing 9%. In terms of the sales growth, well, 5 to 10% for essentially REITs, other companies 3 to 7%. Over the last 4 years, looking very strong double-digit increase, but we can see a slowdown on the trailing 12-month basis. In terms of total sales numerically, well, 200 million in 2017, 3.61 billion in 2023, so a large increase over the last few years. And in terms of shares outstanding, very common with REITs, they will essentially dilute your position over the longer term as they don't retain a lot of that internally generated cash flow. The majority is paid out as dividends. Just bear in mind though, Vici Properties, amongst other REITs like Realty Income, do dilute your position at a very rapid rate. In terms of ROIC, we do lower this down from the initial 10% to 3 to 5% for REITs. No worries whatsoever for essentially Vici Properties, 8% 2 of the last 3 years. So let's move on then to the operating margin. We can see very healthy over the longer term, so nothing to note there. Again, free cash flow margin, not much to say, not massively relevant for REIT. Finally, one of the reasons why we do see that borderline safe score on the dividends, net debt to EBITDA below 3.5, and it has been pretty much for the majority of the last 10 years above that level, 5.86 in 2023. Granted, it is expected to come down to 5.41 in 2024. It is still high and therefore something you should take into consideration before executing on this company. In terms of looking at the valuation model, and don't forget you can grab a copy by clicking on the pinned comment below, running your own numbers through to get your own intrinsic and acceptable buy price. Margin of safety at 10% indicates a buy up to $33.55. At 20%, we can see it $29.83, and at 25%, pretty much around the current trading price. So if you do see it around a $28 mark, you are getting a 25% MOS level, but remember that is based on the estimates and judgments. If any of these companies you want to see a deeper dive, do let us know, or if you do want to see them, we have probably reviewed them over the last few months, so do take a look. What we do note then, the upside from Wall Street, 24%, so that is very strong. $35, marginally lower than our intrinsic value. So for a recap then, for Vici Properties, 25% MOS, 24% upside. As always, let us know your thoughts in the comments below, whether you have also added to any of these. Maybe they're on your watch list, or for whatever reason, maybe you don't want to touch them. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and we'll see you all, as always, on the next one.